This session is sponsored by BKD. So they are a national CPA and advisory firm that can help you reach your goals. Their expertise is well beyond the standard accounting services that include risk management, technology, wealth management, foreseeing and valuation services. Their clients represent a wide range of industries and even part of an alliance of firms that gives them a global reach. Thank you for your sponsorship. So this session is Provider Relief Funding by Rebecca Robbins and Andrew HEJTMANEK. Did I do that right?
Yeah, absolutely. You got it.
Perfect. So a little bit about Rebecca. She goes by Becky. She is a member of BKD's National Health Care Group and BKD's National Not-for-Profit Group with more than 12 years of public accounting experience. She provides audit services to a variety of organizations, including not-for-profit, for-profit, and government hospitals, continuing care retirement communities, home health agencies, and providers, as well as higher education institutes and other not-for-profits. She's presented on accounting and audit topics for Oklahoma Association of College and University Business Offices and BKD's Higher Education Summit. She's a member of several professional organizations and affiliates, and she also serves as treasurer for Meals on Wheels for the Metro Tulsa area. Andrew is a member of BKD's National Healthcare Group and has more than 13 years experience providing accounting and audit services to healthcare providers, including hospitals and healthcare systems, cancer treatment provider, nursing facilities, physician practices, and other such entities. He also serves as co-director of the Accounting Outsourcing Services Department for the BKD's Tulsa office. He also is a member of several professional organizations and affiliates and is currently serves as past president of the Oklahoma chapter. Andrew also serves as Tulsa's Habitat for Humanity, including a time as chair of the board of directors, and currently serves as the board of directors for the Emergency Infant Services. Please welcome both Rebecca and Andrew.
Well, thank you so much, Tammy. I really do appreciate it, and I certainly appreciate those nice words. But I sometimes hate how wonderfully perfect those intros are. So, really quickly, I could introduce Becky and I very briefly. So, Becky and I are directors in BKD's National Healthcare Group. Tammy just said that. While the two of us reside in Tulsa, Oklahoma, from a geographic perspective, we share clients and serve clients across the country. So those are going to include Tulsa, Oklahoma, Utah, California. We work with hospitals in Mississippi, Arkansas, and elsewhere. So, you know, like many of you over the past year, we've been doing our regular jobs, and at the same time, we've been dealing with this thing that 1 year ago today, or maybe it was 1 year ago last week, we were in Las Vegas for the Western Symposium, and we had no idea was coming. Namely, we had no knowledge of what this CARES Act was and what provider relief funds were and the PPP program and what the coronavirus was. And yet here we are, having spent far too many hours that we like to admit, learning about, counseling with our clients, talking about, and provider relief funds. So by this point, many of you are likely familiar with the provider relief funds. If you're listening to this webinar, you already know that there's so many things going on. You're probably familiar with it, and you're probably exhausted by them. So what we want to do today is we want to just jump straight in, talk about provider relief, and hopefully give you a little bit more clarity as to where we stand as a result of the post-payment notification that came out on January the 15th. And I will also say this before we get started. It was really nice that HHS decided to release this notification of information, or this new release of information, on the 15th, and gave us a whole 6 days to get updated before we put together this presentation, because quite frankly, many of the other times we've presented, it has resulted in us either getting information at the very last second, or I have been presenting when new information drops have occurred. And as a result, what I said is essentially not relevant anymore. And I had to go back and repeat that with the new guidance. So it's really great that we had the time to put real information together for you as to where we stand right now. So the goals for today, we're going to go really briefly over the provider relief funds and the provider relief, or the FAQs that have come out to date. Really, we're not going to get too much into the weeds. We're just going to kind of point out where we came from and how we got to where we are today. Then we're going to talk about the January 15th post-payment notification, where we stand. We're going to discuss the reporting requirements. As you all know, the reporting requirements up until January 15th included a deadline of February 15th for you to report on all the information through December 31st. What changes have been made to that as a result of this post-payment notification? Becky's going to cover a few minutes of single audit update just to provide you with a standing on where we are on that particular topic. And then we're going to ask questions or identify questions where we still don't know the answers, because to this point in most of our presentations, that's been one of the biggest issues that we have, which is here's the things we don't know the answers to. And so hopefully we can provide you with a little bit of information. I would strongly encourage you to submit questions via the question and answer feature if you are interested in doing that. Provide us with an opportunity to ask questions or answer questions at the end, but if there's a relevant question and we're still covering that particular piece of information, perhaps we can interrupt what we're saying to answer that question, especially if it goes along with what we're covering at that point. Really brief disclaimer, and I don't know if you've seen this or not on any other public accounting firms as they're going through provider relief, but this information is updated as of today. We're going to talk about in just a few minutes the fact that the FAQs are covered through, I think it was also January 15th is when the last FAQ was released. That's relevant because they dropped those FAQs so quickly, it's hard to know when they change, and sometimes those FAQs can have pretty significant implications to the reporting and or how you can keep some of those provider relief dollars. And the other fact is that HFMA, the AHA, AICPA Healthcare Panel, all the lobbying organizations and the relevant professional organizations continue to translate some of this data and help to provide context to it, and in some cases lobby for changes to those rules. And so they can change almost daily and have in many cases to this point. So really briefly, I wanted to go over the provider relief summary and where we're at. This slide really represents a general breakdown of the approximately $175 billion in provider relief funds that's been funded through the various legislative acts over the past year. Most of you in attendance today are going to represent organizations that have received payments through the $90+ billion in phase 1, 2, and 3 general distributions. There are also likely many of you who've received either rural relief payments, COVID-19 high impact area payments, the safety net and children's hospital payments, all those targeted funds. Every hospital and facility is different based on their underlying conditions and structures. And so a lot of you are going to receive a lot of those different payments based on the makeup of typically the people we see at these HFMA meetings. That's probably going to cover most people. There might be a few nursing home and long-term care representatives here in the audience today, and some of those are going to have a little bit different specifics with respect to the terms and conditions that we're going to apply or discuss in just a minute. But the big, vast majority of you are going to be represented by the buckets that I just described on this slide. So as just mentioned a few minutes ago, the underlying guidelines for all these distributions, both the targeted and general funds, are HHS's terms and conditions. And of all the terms and conditions, I really want to call to your attention this top line, this top bullet point that really points out, it's kind of like the basis for all of the funds that you have received to date and will have to report on. And those essentially say that you have to use those funds to prevent, prepare for, and respond to the coronavirus, and that you can only use those funds and be reimbursed if those funds were used for healthcare related expenses or lost revenues. So I know that that's probably something that at this point is like drilled into your mind, because those are some of the most common phrases I've heard over the last year. But it's really important kind of to keep that as a baseline for the rest of these conversations. Those funds have to be used to prevent, prepare for, and respond to the coronavirus, and they have to be used for healthcare-related expenses or lost revenues. And then really briefly, a timeline of how we got to where we are. Obviously, you know that in early 2020, the coronavirus outbreak became a pandemic. In mid to late March and April, most of the legislative action by Congress and the president geared towards addressing the pandemic were put into place and signed into law. So the CARES Act, the follows up to those CARES Acts, those were all passed in late March, early April. Then about early May, we started to see the frequently asked questions addressed on the website. As I said just a few minutes ago, those frequently asked questions continue to be updated, and I expect that there will be more updates in the future that will change at least minutia with respect to what we're going to present today, if not significant changes. Because as you're all aware at this juncture, the fact that we had some pretty significant changes at the federal level over the last few days, we don't really know what impact that's going to have on the translation or interpretation of some of these rules and what Congress has written, both in the original CARES Act as well as in the Consolidated Appropriations Act that helped to change a lot of these rules. So there may be further guidance that comes down from HHS as a result of the change in administration that might be meaningful, but at this joint, we just don't know exactly what that's going to be. So those frequently asked questions have continued to pile up over the last 9 or 10 months. In September and October, the initial post-payment notifications were released that essentially significantly changed the guidance that we've been operating under for the first 6 months. I have had many conversations with clients with respect to what do we do now that they've changed the guidelines, and how do we respond, and what can we spend these dollars on, and are they going to change the guidelines on us again? As a result of those conversations, a lot of the lobbying and efforts really started and hinged from there. The Consolidated Appropriations Act that was passed in December and signed by the president, I want to say on like the 26th or 27th, really furthered a lot of the changes. They had started when September kind of whiplashed a lot of the guidance. October started to pull it back, and the Consolidated Appropriations Act really moved it towards closer to where we were from the FAQs from the beginning, which is a positive thing in most cases. And then, as I said just a few moments ago, the HHS released the post-payment notification on January 15th, which has dramatically changed where we are today. And so with that, what I want to do is I want to turn it over to Becky to discuss. Oh, I'm sorry. Yeah, and there is a link, and when we do release these the slides, there's a link to the frequently asked questions. Although most of you, if you've ever looked at them again, already know how to find them. There's about 60 pages. If you PDF it, there's about 60 pages of FAQs right now. So there's plenty of good reading if you're interested. And with that, I will turn it over to Becky to discuss where we are today.
Yeah, so we're going to talk a little bit about what that most recent guidance did, and then kind of where we stand as far as reporting for the provider relief funds and what you can record for the provider relief funds. So the guidance last week that they issued in that new post-payment notice, along with having that information on how to register on the reporting portal, but also had guidance related to some new information for the general and targeted distributions from the provider relief funds. It continues, as Andrew mentioned before, to say that this doesn't cover the skilled nursing infection control or the rural health clinic testing funds that are out there, because those have separate requirements that HHS outlined in the terms and conditions. So nothing there that needs to be covered. Yeah. Really, the biggest change that came out of this notice is that it reverted how lost revenues would be determined back to the original guidance from HHS from June of 2020. This really was because of the 2021 Consolidated Appropriations Act that was passed. It mandated that change. It was actually written in the Appropriations Act that had to go back to that original guidance. And so really what this does is it just gives more options for everyone to be able to record lost revenues and how they can calculate that. Outside of that, the The January 15th notice didn't really make a whole lot of significant changes to the guidance. It didn't really change much in the realm of what is healthcare expenses attributable to the coronavirus. We did note that when referring to the general and administrative expenses, the language in the past had not included the language of it had to be attributable to coronavirus. And in fact, there had been a couple of FAQs around the concept of marginal expenses being able to be recorded. This seems to potentially imply that even if you're going to claim marginal costs or marginal expenses, that you're going to have to directly tie those back to an impact from the coronavirus in some way, and that you can't just say it was pre and post pandemic, therefore those marginal expenses can be claimed. But that, again, that's just kind of implication based on language, not specifically lined out. Outside of this, there really wasn't any other significant changes as far as how things are to be recorded or reported. It's still the same two-step process that was outlined before, where healthcare entities identify your costs first and then your revenue, lost revenue second. And what it didn't do is open up the portal for reporting. It provided, along with this, they issued the guidance for how to register on the portal, but the portal is not open for reporting. And at this point, there is not any information as to when that will happen for sure. So the original February 15th date still kind of sits out there, but based on information that's available, everyone kind of assumes that will get moved down the road once we get there. So you can move to the next slide. So really, when you look at the biggest change that came out of this, it's the change to how you can calculate lost revenues. And what this did is it gives you three options for reporting for calendar 2020. And what I'm going to cover here is that there's actually a distinction between the reporting for calendar 2020 and the reporting in fiscal 21 for the 6-month period to June 30th, when you can claim costs and lost revenues through. So for calendar 2020, your three options are, one, still that you can look at the difference between 2019 actual and 2020 actual patient care revenue. This is the guidance that's been out there most recently as to how it was going to be calculated. The second option is that you can look at the difference between your 2020 budgeted revenues and your 2020 actual patient service revenue. This is an option I think everyone was happy to have back, but it's a little complicated because the language does actually say that it has to be a budget that was established and approved prior to March 27th, 2020. And this, again, is language that came out of the Appropriations Act. And so this is the language that they're using here. But for entities that aren't 12/31 calendar year or probably a 3/31 fiscal year end, it might be unlikely that your budget for the bulk of fiscal year 20 or for calendar year 20 was approved by March 27th, 2020. And so it raises a lot of questions as to how you're supposed to compare to budget if your budget for the latter half of the calendar year wasn't approved at that point. It seems like the intent with this was to keep entities from potentially inflating lost revenues with kind of a hindsight budget, but it definitely causes some unique questions that hopefully will be addressed by an FAQ to come here in the near future, especially since reporting seems like it's an imminent thing. The last option that you're given as far as lost revenue is now you can use a method that is called any reasonable method of estimating revenue. So really, they're opening this up to if you don't like the option of actual to actual and you don't like the option of budget to actual, you can calculate it in any manner that you deem to be reasonable, which gives a lot of flexibility, which is great, but it does come with some complications. One of those is that if you choose that method, it's going to open you up to a much higher likelihood of audit by HRSA. The reality is if you use that method, they're going to look at it. The second is that you have to provide a lot of information if you use this method. You have to be able to explain why the method is reasonable, and you have to truly be able to tie a link to the method that you're using and the fact that that lost revenue is attributable to the coronavirus and not to some other source. So These sorts of things are not required necessarily if you use one of the first two methods. You don't necessarily have to have all of that documentation submitted as a part of the reporting. But if you use this any reasonable method option, there's a lot more information that's required there. Now, it does say that if you use this method and they come in and they come back to you and say, your method is not appropriate and we can't let you use that, you will have 30 days to resubmit using one of the other two methods to claim your lost revenue. So you do still have some options if you take this method and ultimately they throw out what you did to go back to one of the other two methods to get your, so still be able to claim lost revenues. So there are still options out there, but I think overall people were pretty excited about this change because it really just gives a lot more options for coming up with a lost revenue number and not feeling so tied to one method. So as I said, the guidance for 2021 for the 6 months through June 30 that you can record any additional expenses or lost revenue if you hadn't used all your funds by the end of 2020 is a little different for lost revenue. You don't have as many options. You basically have two options. The first is that you can compare 2019 quarter 1 and 2 actual revenue to 2021 quarter 1 and 2 revenue. Or you can compare 2020 quarter 1 and quarter 2 budgeted revenue to 2021 quarter 1 and quarter 2 revenue. So there's not the alternatives for any reasonable method like there was for 2020. Also, you don't have any options as far as using actual 2020 to 2021. It's budgeted 2020 to 2021 or actual 2019 to 2021. So it does give you a couple of options there if you do ultimately need to use the rest of those provider relief funds in 2021, but not quite as much flexibility as there was with the 2020 calendar period. So where does that leave us? I mean, really, as I said before, the changes were not super significant outside of the additional revenue options. A lot of things didn't change. We're still using the two-step approach to determine funds that can be earned, look at expenses first, look at lost revenue second. One of the most important things I think that I would point out here is that having a good method for tracking your expenses that you intend to claim in that first step so that you have the ability to provide the support for reporting those expenses is going to be really important. I think that the rationale behind some of those expenses that we call attributable to the coronavirus is going to be a key issue that they're going to look at. I think the other thing that didn't change with this, which I think everyone is happy that it hasn't changed again, is that capital and inventory related expenses that are attributable to the coronavirus are still allowed to be claimed as expenses and for purposes of keeping your funding. So, they went back and forth with that. They said, no, you're not going to be allowed to claim capital expenses if it's for anything that has a life longer than a year. And then they came back and said, oh, no, wait, that's not what we meant. Really, you're allowed to do it for anything that you can directly attribute to the coronavirus. So they're standing with that FAQ, and nothing has changed related to that. But again, I would caution you, particularly related to those capital and inventory costs, that you need to have the documentation to support how those purchases directly related to the coronavirus. I think it's going to become important in our conversation a little later as we talk about single audit, but even the opportunity that they have to audit your reporting that you do to HHS, those kinds of questions could be asked. As I said, the thing that mainly did change is the calculation for lost revenues. I think really overall what we would recommend is look at the computation from multiple angles and figure out what's the best method for your entity. I think everybody is going to find that there's different approaches that work best for their facilities, and it's going to be important to make sure you're looking at it from all the ways that you could be looking at it to determine what the best method is. If you intend to follow that any other reasonable method approach, just be sure that you have everything fully documented, including your rationale for how you're only capturing lost revenue due to the coronavirus and not because you lost a provider or some other organizational change that really would have impacted your revenue. You need to be able to show that it's truly coronavirus related. I think really finally what it leaves us with is some additional questions of what didn't come in this post payment notification. It added the additional language of attributable to the coronavirus related to the general and administrative expenses, which leads some to question if there's going to be a requirement that all marginal costs that are claimed also have to specifically be tied directly back to coronavirus as the source of those changes. So we don't know exactly what that's going to look like, or if further guidance will come out, but that question is out there. But I really think probably overall the biggest thing that didn't come out of this post-payment notice is the actual reporting portal. And so there's still some questions there, but I'm going to hand it back over to Andrew to talk a little bit about the reporting and what HHS is going to require and kind of what we know at this point.
Thanks, Becky. So now that we understand where we are, let's take a few minutes to discuss the reporting requirements that were included in the January 15th notification. And as you might recall, organizations were initially required to report to HHS by February 15th for amounts expended through December 31st under the original expectations, or under the original notice of reporting requirements. However, that obviously did not happen. The January 15th notification does indicate that part of the reporting portal is now open, just not the part we were expecting. So instead of allowing you the opportunity to actually go in and attest, they created a registration part of the portal that allows you to go in and register to attest, so that when the portal is actually ready to do so, you can go ahead and start the process. The instructions, ironically, for the registration part of the portal itself is a 25+ page PDF that can be found online and encourages you to pre-register so that you can receive your email that will notify you, being the individual who's assigned to register, or excuse me, to actually attest for your organization when the portal is ready. So just so you're aware, some of the pieces that are of information that are needed when registering so that you can later on attest to on the portal include your contact information, tax ID and business name, including all subsidiaries, and any organizations that are fairly robust with the number of organizations that they operate, including different facilities, hospitals, physician groups, things of that nature, should keep that in mind. And they're expecting you to submit payment information on the registration part of the portal. So tax ID, the amounts that you received, the method of payment, whether you got a check or we'll call it an EFT or a draft. You'll need to include the check number on which you received that. At least that's what they're saying right now. Or the date of the EFT that you received each of these payments. I mean, I say this tongue in cheek, but just remember, this is what you need just to register to attest to the portal. So I suggest you get your ducks in a row, because the portal very clearly says that when I went out and clicked on it, that you can't come back. You can't save your work and come back to the registration part of the portal. You have to go all the way through it. And the website says that it'll take approximately 20 minutes just to register. So be prepared with all that information that's on the slide in front of you, but anything else that you might see that becomes important that I didn't get the chance to summarize on this slide. So when you're walking through the post-payment notice, the first piece of information you'll be required to report on relates to healthcare expenses attributable to the coronavirus. So the important thing to remember here is that the only expenses that can be claimed are those not reimbursed from other sources. So not only did Becky say a few minutes ago that they have to be attributable to the coronavirus, but they also cannot be reimbursed from other sources. So we're going to discuss that in a few minutes, what those sources could potentially be. But a safe rule of thumb in my mind is if you would not have received any of those dollars except for COVID, then you likely need to reduce the reimbursement that you're requesting or you're attesting to by those amounts for the purposes of this calculation. So there are two separate levels of reporting for entities who receive between $10,000 and $500,000. The information only requires that you disclose those net amounts reimbursed to you in two categories: general administrative and other healthcare related expenses. But I'm pretty sure that most of the people represented on this call today aren't going to be in that category. Most of the organizations represented on this call are probably going to be entities who received over $500,000, in which cases you are required to disclose the actual expenses in a much higher level of detail than those in the previous category we just discussed. So you're going to have to disclose general administrative costs, that are mortgage and rent, that relate to insurance, personnel costs, fringe benefits, lease payments, utilities, and other operations, and then other healthcare related expenses, including supplies, equipment, IT infrastructure, and facilities. There's just a lot more detail that you're going to need to be prepared to disclose as you go through this process of attesting. So with respect to reporting for lost revenues, as we discussed ad nauseum earlier in the presentation, we've seen numerous changes to this particular category over the last 9 months. Where we landed, as Becky said just a few minutes ago, is essentially 3 options for reporting and attesting for lost revenues. Comparing 2020 actual to 2019 actual, 2020 actual to its corresponding budget, and then using an alternative methodology. So regardless of what method you choose to report under, you will be required to submit one piece of information, and that is total net revenue from patient care by calendar quarter by payer mix for the year 2020. As a function of that, the payers that you're going to have to be required to report include Medicare A and B, Medicare Part C separately, Medicaid, commercial, self-pay, and other. So each of these buckets are going to have to be disclosed in each combined bucket per calendar quarter for 2020. From there, your selected method of reporting will impact the information that you'll be required to submit via your attestation. If you're using the 2019 actual versus 2020 actual, then you'll also be required to provide the same information for calendar year 2019. So again, net revenue by payer by calendar quarter. If instead you're using the 2020 actual as compared to the 2020 budget, then you'll be required to submit a copy of your budget, and that budget is going to require to be approved on or before March 27th, 2020. As a function of that, you'll be required to submit an attestation from the CEO, CFO, or another C-level individual attesting to the fact that that exact budget in question was approved on or before that date. And then lastly, if you're relying on an alternative methodology, they're going to expect that you can provide a description of the calculation that was selected, an actual copy of the calculation itself, and how you got to the amount that you're calculating, a documentation on why you believe that that method is reasonable, and then a description of how lost revenues was due explicitly to COVID and not to another source or cause. So again, just be reminded that if you note that just be reminded that the notice of reporting requirements very explicitly explains that those organizations who use that alternative methodology are going to face this increased scrutiny from HRSA. We do not yet know what that looks like or how meticulous they're going to be in their scrutiny, but it's just important to be aware of it because this is how they're going to expect you to attest, so it's not as if they're not going to know. They will know exactly how you came to the numbers that you did because you're going to tell them. Other important pieces of information that the reporting requirements list that you will be required to disclose include both financial and non-financial items. So assistance received from other organizations related to COVID or coronavirus. If you'll recall a few minutes ago when discussing the reporting of expenses, we mentioned that all such expenses must be reported net of reimbursement from other sources. These are the sources that we're talking about. So that's if you got a PPP loan or some other SBA assistance. So if you got the EIDL loan, for example, if you got any other CARES Act funding, and sometimes that can come from other sources through the state and local governments, for example, FEMA, reimbursement for COVID-related testing. If you had any business interruption insurance, state and local government or tribal assistance, we see a lot more tribal assistance in Oklahoma, and there are some along the West Coast that might see some funding coming in from tribal sources. Additionally, there's going to be some non-financial pieces of information that you'll need to be able to discuss. Were there any changes in ownership of your organization or any of your subsidiaries? They had quite a few personnel metrics that they expect you to disclose, patient metrics and facility metrics. So there's quite a bit of other information that I'm not sure is specifically pertinent to the attestation, but HHS certainly thinks so. And then the last one, I want to call your attention to the last bullet point on this particular slide, interest earned on provider relief funds. So one of the items that's explicitly listed in the post-payment notice of reporting requirements requests that your organization disclose the amount of interest that you earned on the provider relief funds through interest-bearing accounts while you were holding those amounts. That interest essentially is going to be added to the amount that you received, and you have to be able to justify keeping it through the same methods we just discussed, or you will have to return those funds. So the government not only has given you all these dollars, and in many cases changed the rules on how to keep those dollars and what you're going to be able to do with them, but if at the end of this process you have to return some of those dollars, you also have to return the interest that you received on those dollars from a bank, even if it was 0.1%. So there's an interesting add-on that I don't know that people have been talking about yet, and it's probably not material, I admit it, but it seems ironic given the fact that Novitas typically, or excuse me, that HHS CMS typically charges you 10% if you have payments that you owe back to them, or if you have extended repayment plans. But when they see a chance for you to earn 0.1% on money at a bank, they certainly want it back if at all possible. So. And with that, I will allow Becky to spend a few minutes talking about everyone's favorite topic, compliance and single audits.
Yeah, so single audit, I think, is the topic that has come out of the provider relief funds that a lot of healthcare organizations never really had to deal with before. So it's new to a lot of organizations. Some have been through it before, but it does provide kind of a unique, potentially one-time or two-time thing that has to be done by a lot of healthcare organizations that haven't done it in the past. So the long-awaited compliance supplement addendum was a wonderful Christmas gift the week of Christmas that came out finally, that gave the guidance that outlined what single audits are supposed to look like for the federal grant funding that came from provisions of the CARES Act, which obviously included the provider relief funds. But I really want to kind of stop here and say one thing, that is, be aware that the provider relief funds are not the only federal funds that were received by a lot of healthcare organizations as a part of the CARES Act. This slide here lists 4 of the new programs that were established that all have in some way impacted some healthcare organizations. The Coronavirus Relief Fund, those probably weren't paid directly to healthcare organizations, but there were a lot of states that passed that money through to healthcare organizations. So that is federal funding that was provided. You've got the telehealth program, which is through the FCC, which there were a lot of grants paid out through that during the year. And then you also have the reimbursement for the testing for the uninsured, which comes as a per patient reimbursement, just like any other reimbursement, not as a lump sum grant, but it is a federal fund subject to single audit. So just being aware that there are other programs out there that potentially could get you to the $750,000 threshold of what requires a single audit, and not just the provider relief funds. And that becomes a little more important when we get to the next slide, because you're going to see that not everybody is going to have a single audit for provider relief funds in the first year. So you can go ahead and move forward the slide there. I think so when they came out with this new compliance supplement, one thing that was confirmed that we all kind of had heard was that if your fiscal year end was before 12/31/2020, you are not required to have a single audit on the provider relief funds for that fiscal year end. So basically what they're saying is they're not going to require any single audits until people have done reporting. So because the basis of the single audit is actually going to be on what you reported to HHS. So if your year end is December 31st, 2020, you're going to be required to do a single audit if you received more than $750,000 worth of funds based on what you reported to HHS as for the calendar 2020. If you have a year end from January 1st to June 29th, 2021, you will also have a single audit based on what you reported for calendar 2020. So unlike most federal funds, if you've ever had a single audit before, you know that typically it's based on your expenditures during your fiscal year. But the way that they've set this up with the provider relief funds is that they're basing it on the periods that you've reported to HHS as opposed to your fiscal year. So it will not necessarily reconcile to your fiscal year financial statements. So be aware of that. That's a little different than most other things. If your year end is June 30 or after, technically you'll have to wait until the 2021 compliance supplement to know kind of what the guidance is there. I wouldn't anticipate that there be any significant change to what is done, but I would guess that probably starting with June 30, 2021, you're going to be working off of what you reported both for calendar 2020 and then also what you reported for that 6-month period through June 30th of 2021, since that reporting will also have been complete at that point. So this slide really just shows the compliance requirements straight out of the compliance supplement. Fortunately for provider relief funds, there were only 3 compliance requirements that were noted as being applicable, and that's activities allowed, allowable costs, and reporting. Pretty straightforward. You can go ahead and move to the next slide. So really what this is going to be looking at is activities allowed and allowable costs is going to focus on if the expenses you reported and the lost revenue you reported was truly attributable to the coronavirus. So it was to prevent, prepare for, and respond to the coronavirus, and that money, those funds were not reimbursed by some other source. So both of those things are going to be looked at as a part of your single audit testing. Similar to how the guidance coming out of HHS has been different for the skilled nursing infection control program, that guidance will be what's followed for testing that piece of the provider relief funds. I mean, really what ultimately came out of this is the testing that's going to be done by the audit firm that's doing your single audit is going to be based on the guidance and the FAQs. And so there's not in any anticipation that there's some set of rules that HHS is going to throw out there that's very specific. It's going to all go back to those FAQs that we've all been looking at all along. So I think that kind of knowing and understanding that as you're doing your reporting, that's going to be the same premise by which the single audit is done. The other piece that is going to be looked at is more of the compliance focus around the reporting. So did you do your reporting? Did you do all the aspects of your reporting that you were supposed to have done? And it basically says that it is going to require that you did your reporting based on the requirements issued in this. It said September 20th, 2020 notice, but then it also says, and any subsequent notices. So any changes that come out, including this most recent one in January, are included in the guidance there as to what should and shouldn't be reported and when it would need to be reported by. So that's the other aspect that will be tested. There's a link in the slides there to kind of those reporting requirements. I don't know how many of you represent for-profit entities or have maybe for-profit entities as a part of your organization, but there was some initial confusion as to whether or not single audit requirements would apply to for-profit entities. Generally speaking, what the government terms as a commercial entity or a for-profit entity is not subject to single audit. Ultimately, HHS says, well, okay, you're not subject to single audit, but we still want you to do something. So you have options if you're a for-profit entity. You can choose to have a single audit if you so desire, but you also have an option for what's called a financial related audit of the award conducted in accordance with governmental auditing standards. What that means is yet to be determined. The AICPA has been working through what the guidelines and the outline of what they believe this is supposed to look like. Our understanding at this point is that they and HHS are now kind of going over that and determining if HHS is going to give the thumbs up of approval for those guidelines that the AICPA has put together. If it does, then that will kind of get pushed out to be, here's what needs to be done. But the understanding is that this is a less kind of intensive version of a single audit. So there's things that have to be done as a part of a single audit that may not have to be done as a part of the this financial related audit that they've talked about. So more to come on this, but it sounds like that there is an option there if you're a for-profit entity to have something done that's not quite maybe as time consuming or costly as a full single audit. So more to come there, but that's really all we know at the moment. Andrew, I will turn it back over to you to kind of finish up.
Well, at the end here, I just wanted to finish up with a couple questions. Like I said at the beginning, what questions do we still have? What are we still waiting to find out about? Any of you who've been following this with great intent are aware that at almost every point in the process, there have been a ton of questions. And now's no different, although I will admit that the questions do seem to have been shrinking in number, and quite frankly, in many cases, the impact as well, as HHS has continued to refine that guidance and hopefully not backtrack any further. The biggest question that I have, we've already pointed out to you today, is what is the deadline for reporting information as of December 31st? As we said a few minutes ago, the January 15th notice does not seem to address this, other than to provide you with an opportunity to register to report, and then suggest that once the portal is available, those who have registered will receive an email indicating that they can go in and report. So at some point we will see guidance, and that will also be made known on the website, I'm sure, about when you are actually going to be required to report. But just based on the way the government works sometime, and based on the fact that there's transition at the federal level, I just anticipate it might be a little while. Another question that really looms large right now is whether the method allowing for budgets compared to the 2020 actual can be used for organizations that don't have calendar year ends. We just talked about this a few minutes ago, but the requirement that those budgets be approved by March 27th, 2020 all but rules out organizations with June 30 year ends through the end of the calendar year, and many others, as those budgets in all likelihood would not have been approved in time for the March 27th, 2020 deadline. So along those lines, could an organization with a non-calendar year end like that use some kind of combined approach whereby they actually compare they use the budget to actual for the periods that are allowed, and then they use the actual to actual for the remaining months? And if is that okay, or does that represent an alternative methodology that would subject them to additional higher audit risk? These are all questions we don't necessarily know the answers to at this point. We're hoping to hear back from HHS soon. And then the last question would be, along those lines, will HHS and HRSA allow for an alternative methodology for lost revenues that includes some kind of comparison for only a limited period of time? I know that it seems unlikely, but I've received this question so many times that I want to make sure that we address it. There are some who are still asking the question, well, what if I believe that I could support the dollars through 6 months of the period in question, and after that I start to lose my opportunity to keep those dollars because my budgets or my actual went back up? We don't know the answer to that right now. I mean, it doesn't appear that loophole is available, but at the same time, when the question keeps popping up and organizations keep asking those questions, lobbying organizations are talking to the federal government about it, you never know what's going to happen. And then lastly, although I didn't include it on this presentation or on this slideshow, as I said a few minutes ago, the biggest impact may be the fact that we have a change in administration and leadership right now. And what does that have? What impact does that have on the reporting process, on the keeping these dollars processed? Do rules get relaxed even further as a result of the changing in administration? How much more funding might be available to organizations as a result of the change in administration and potential additional legislation to come down pike in the next month or two. We don't know right now, but it certainly poses a lot of real opportunities potentially, and something to keep aware of. And as a result, we will do our best to keep you aware, and we can update you as much as you'd like. And we are really just glad that you allowed us to be here today, and we just want to say thank you for the time. Now, with that, really quickly, I did want, Tammy, I know I would love to entertain any questions if there are any.
There actually is, Andrew. So one of them is, what if the business interruption has not yet paid any claim or coverage, but you anticipate getting some in the future?
Pete, I think that's a great question. And I don't know the answer to it, to be honest with you, because the way that the rules are written, I would anticipate that the intent would be that, yes, you would have to reduce the amount of provider relief funds that you could claim as a result of even pending insurance claims from business interruption. Becky, what do you think? Does that sound fair to you? I mean, like,
I think the intent is probably there. The way the post-payment notification reporting is written says that what you're reporting is receipts during the period that they're talking about. So as far as what you report for calendar 2020, if you haven't received anything, I don't think you report anything. I have to anticipate, though, that they're aware enough that business interruption claims don't pay out quickly, especially when we're talking about claims related to a pandemic. Because, I mean, depending on the policy, some policies specifically omit those kinds of things from being included, and some don't. So I think that they probably are aware that those are probably kind of longer payouts. So I don't know if when you do your reporting as of June 30, 2021, if there's going to be any requirement to update for any changes that happened to what you had previously reported. I mean, that could be something that they choose to do.
Okay. And then another one is, are there requirements to disclose pending financial reimbursement, i.e. pending business interruption insurance claims?
Yeah, so not at this point, but that doesn't mean that they can't.
I would agree with that.
And I think those are our questions.
We got one from...
One just came in, it looks like.
Oh. Yep. Can you see it?
Yeah, so let me read it really quickly, and because this one might take me a few minutes to digest. Can you comment on multiple locations with multiple TINs and whether you have to aggregate provider relief funds if individually they are below the single audit threshold? Actually, that's a pretty straightforward question. Becky?
So, and this is, you're asking from a for-profit perspective, and I can't tell you with 100% certainty that they're going to follow exactly what they follow from the single audit perspective, but let me tell you kind of how that would work under a single audit, which is that you have options. So you can choose to report you can choose to do your single audit as a consolidated entity of all the TINs together in one single audit, and you would aggregate all that together, and it would just get tested one time. So provider relief funds would get tested in the aggregate for all of your TINs together. You can also choose to do them individually, and then you would only have to do a single audit for those that have aggregate federal funds above $750,000. I have seen it done both ways depending on the organizational structure. I have seen some instances where you have a publicly owned entity up here that holds a lot of individual hospitals or healthcare entities, and they choose to have them done individually because not all of them have to have them. And as a public entity, they don't really want that on their financial statements. I have also seen where you have, huge chains of, in this case, like nursing home facilities who do it all together every year. And so you have that option basically to elect once, though. So once you've done it, either consolidated or not consolidated, you can't go back. So you have to kind of make that decision in the first year that you have to have a single audit and go with it. But as I said, from a for-profit perspective, I am making the assumption that HHS is going to allow you to do it in the same way, to have the option to do it either way. But This is kind of a newly blazed trail, because normally for-profit entities are just not subject to this. And so
They don't get federal dollars.
yeah, it's just a very unique circumstance with this, and the provider relief funds in particular are unique in this way. I think the only other federal funding that we saw that was going to for-profits was the PPP loans, which are not subject to single audit. So it's just kind of unique. And so, as I said, that guidance isn't fully out yet. The ASCPA has put together what they think it should be, but they're still waiting on the blessing of HHS, and we all know that that's not always the fastest thing in the world. So more to come.
Well, I think that is our question. So what a great session full of great information. I really appreciate you guys attending the Oregon chapter conference, and we hope to see you in person at one of our other chapter conferences.
Wait.
We hope we can be there soon.
The next Falashan can't come soon enough.
We all feel the same way.